This conference will now be recorded.
Hi, and a very good afternoon, everyone. This is our sixth sessions. Good afternoon, Anirban. If my audio video is fine, just request you to give me confirmations in the chat box. Sarup, good afternoon. Atul Ketki, Anil, everyone. Thank you for joining in. So, sixth session is saved for a quick check, revision of the strategies, the approach on any one particular charts or whichever chart on whichever time frame. Another approach in which one can initiate trades using the aim and shoot strategy and ride big trends if possible. Move on to money management using a risk management sheet, and then end with a very important aspect of trading psychology. We're going to take all of these things in our Tuesday session in a completely practical aspect and walk through live markets on Tuesday and implement these as much as possible within that time frame. So one request I'm going to make before I start today's session is that yesterday's session and a bit of first half of today's session would be primarily talking about what to look for on the charts when you're seeking a trading setup. If you have a chart open of Tata Steel, Motors, Maruti, Nifty, gold, Bitcoin, whatever it is, and you seek to do a trade, you want to take a bet, then what exactly should your eyes look for? What is it? What is the setup that you're seeking? So I'm going to refresh quickly on the setups and the trades, the strategies that can be implemented. So I'm using the trading view here. This is a daily time frame, the hollow candlestick charts. So for the trend, we decided that the triple moving averages is something that we'll be using, moving average exponential. The orderly manner of 13, 21, 34 gives a nice zone in any nice trending chart, which helps us to define the trend. If you wish, I can of course keep them in our preferred colors that we discussed. Right. So the logic, the strength of using the triple moving average is whenever there is a nice trend, it will catch that trend and try and hold on to it as much as possible. And whenever there is some degree of noise, volatility, and uncertainty in terms of the direction, the moving averages tend to swing, crisscross each other. And so this gives a certain time. This gives, it's not like any other indicator where it's always an uptrend or a downtrend. It's not always an uptrend or a downtrend. Many a times, like if you notice in this kind of a phase, the prices tend to take a little bit of time to finalize or decide which way it wants to go. At times, after deciding whichever direction it gets, it can lead to a small move, or at times it can lead to a significant move that you and I are not aware of, that no one is aware of. But what I'm trying to say is the difference, the crux, the importance, the USP of the triple moving averages. It's not an approach in which you're always in an uptrend or a downtrend. Means not an uptrend does not necessarily mean a downtrend. The markets are not falling does not necessarily mean that you have to buy. So it always gives a little scope, a little space, a little time for the prices to do what it wants to do, to figure out its trend. And that's a very important thing. That's what I feel is a very important thing about the triple moving average. So the triple moving average is helpful for us to decide upon the underlying trend. Being a swing trader, I would always want to buy into a market which gives a short-term correction in an underlying uptrend or a downtrend. There are various ways. We have decided upon using the relative strength index. And for this, a 3 period, shorter 3, 2 are the ones which I generally prefer. 3 is something which I have stuck to. Earlier I used to use 2. So 3. All the fancy things that we can do with TradingView. There you go. So in this recent uptrend, which we can mark here from more or less at this juncture till the current point of time, the order of the market is positive. And twice it has given us an opportunity. Twice it has given us an opportunity in this zone. And the second time it had given us recently for just one day in the recent fall in this zone. Yes, if the prices rally one way without any retracement or correction, this is something a swing trader misses out. This is for the breakout trader. This is where the breakout trader makes money. This is where a swing trader will not be able to, because the market's not even giving him any chance. There is a way a swing trader can use this kind of a market, but that's for some other program, some other day. But this is what we are focusing. This. So now I know when Kotak Bank came down for last 2-3 days on the 2nd of December, I know that Kotak Bank is in an uptrend and it has got oversold, short-term oversold. And so I repeat again, from this point, Kotak Bank has a possibility of either giving us a continuation of the previous uptrend, or probably it's going to come further down. Our bet as swing traders, we assume, this is an assumption. Every model needs to have some degree of assumptions, expectations. Like when you joined this program, you had certain degree of assumptions and expectation that, come on, you're going to learn something, at least something you're going to learn so that you can trade well. That was a belief, or I would probably say an anticipation. So this is the anticipation of a swing trader. A swing trader always anticipates that the trend will continue. So with this in mind, now that we have found an oversold condition, a short-term oversold condition in a long-term uptrend, short-term oversold condition on this particular red day, this one. Now we'll be looking for buying opportunities. What I shared with you yesterday was you just put in a stochastics, which is calculated based on range movement. And for that, choose a 4 period, choose a smoothing of 3 period and take a 2 period D, something like this, and wait for the crossover, the positive crossover, which comes on this day, this day. When you get that crossover, it is a confirmation that, okay, there is a chance that it can go further up, that is above the high of this bar. If you do this trade, use the current lows, recent, whichever is the lowest point, as your anticipated stop loss. This is an aim and shoot long trade. Okay. As I told you, there's another way in which we can do this. That is by using a 3-day high or a 3-day low. What is a 3-day high or a 3-day low? There's, for example, if you look at the last 3 bars, 1, 2, 3, right? Out of these 3 days, which is the highest point? This is the highest point. This is a 3-day high. And the lowest point? The lowest point is this one. Is this one. It's a 3-day high and a 3-day low. Like this, if you want to plot 1, 2, 3, 4, 5, 5-day high, then this is the 5-day high. But the 5-day low will be a little lower. The 5-day low will be down here. This is a typical breakout strategy, buying strength and selling weakness, volatility breakout kind of a strategy, which was long time back developed and pioneered by Richard Donchian. And there's a wonderful, simple indicator called the Donchian channel. Now, it's not right to call it an indicator. It's just price. You know, it is as good as raw price. However, there's something called Donchian channel. To explain to you Donchian channel, you must have understood by now, but let me show it to you visually how it looks. This is how a 20-period Donchian channel looks like. There are 2 lines, upper line, middle line. Sorry, there are 3 lines, the upper line, the middle line, and the lower line. It's a 20-period. By default, the software calculates 20-period. We can change it later, which means that if I count last 20 candles, the lowest point of the last 20 days is this one. The highest point of the last 20 days is this one. This plus this divided by 2 is this one. This is the average. This is the Donchian channel. If you read about Donchian channel, it's a typical breakout strategy. Very good for trend following. Whenever there's a trend, for example, buy above a 20-bar breakout with a 20-day low as a stop loss. It goes above that, you bought. You continue to hold on as a 20-day low as a stop loss, or aggressively you can use the middle line as your stop loss. In mega trends, whenever there are mega trends, this guy will make a huge, very good, decent amount of money. Wherever there is no mega trend, there is range bound activity, of course it will fail. If you recall, yesterday I was telling you, trend following or breakout, strike rate is very bad. But the number of winners is less, but the size of the winners is huge. This is such one. Donchian channel, if I'm not mistaken, if I had read about it almost 15 years back, Richard Donchian used to trade this on the weekly time frame, at least he claimed to, on a 4-week breakout, means a monthly breakout. A monthly breakout also means in a daily chart, more or less 20-day breakout. So this Donchian channel, if you're buying at this point, you're buying at a 20-day high. Remember, yesterday I was telling you, buy strength, sell weakness. This is Donchian channel. Now, it's not an indicator. I don't consider this to be an indicator because it's just showing me what is the highest point on the last 20 days and what's the lowest point of the last 20 daes. It's not doing any mumbo jumbo formula like an RSI, stochastics, or ADX, or MACD, or anyone does. So I do not necessarily consider this as an indicator. It's just pure price. It is as good as it is raw price. Okay. Now, how can we use this in our swing strategy? This is just another way. I'm not suggesting, I have told you the stochastics way, and that is it. I'm just suggesting you another way. Now, if you've understood the logic of the Donchian channel, it helps us to enter breakouts. It helps us to enter a market which is trying to break out, number one. Number two, it also helps us to ride one-way movements. Whenever the market's going up, one-way rally or fall, it helps us to ride that. So with that understanding back of our mind, let's say if we reduce this Donchian channel to a smaller time frame so that we get a nice entry. Okay, let's say I change it to a 3-period Donchian channel. And a 3-period Donchian channel does not need the middle line. Now come to this point. This was the day when you had a oversold condition. So on this day, you would think to buy above this high. No more stochastics. Then this high, then this high, then this high, and then finally this high. As the market consolidated, you bought above this, you held on to it, and you exit. If you use the stochastics, you would have entered above this, you would have waited for 2 days, and then the market picked up. Who knows, prices could have come down. Who knows, market could have come down after this also. It's highly possible. There are pros and cons of any decision we take. There are trade-offs in every decision that we take. For example, now come to the next setup. This was the setup, this one. The next day, it created an engulfing. Based on the Donchian channel, you would have entered above this high. The stochastics is yet to give us a crossover. Then you could have said, okay, I can go with the engulfing. Let me buy above this with the lower. You could take an extra risk. It would have paid off. However, you wait for the rules, which I will always suggest you to. You would enter above this. Use this as a stop loss. Currently, this is your small returns that you are sitting on right now. So there are always trade-offs. I like this approach. I like this approach personally. Why? Because it gives clarity, very clear-cut clarity in terms of how you will trail your stop loss. This is very important, right? So staying in this Kotak Bank example, let me try and figure out any short trade for you. So did we have a short trade here? Yeah, we had a short trade here. See this? If you want me to remove the background and maybe give it a neutral color so that it doesn't bother us. Yes. So now if you look here, it's a downtrending market. It goes above 75, 75.93. This is a shorting opportunity in Kotak Bank. Now, if you use the Donchian rules, you will be selling below this, which is way too far, doesn't make sense. Now you'll be selling below this. Now the market consolidates, makes a small bar, so you'll be selling below this. And okay, next 2 days it cracks, then it goes up, you exit here, small profit. Anyways, your open profits at one point of time was quite significant. This is if we had done Donchian channel. What if we had used the stochastics? You would have sold anyways below this. So more or less it comes down to the same thing. Not always, not always, not always. Okay, so there are many pros and cons. For example, let me try and find some good example for you. This is, in this case, more or less it's coming to the same thing. In this case, it's also coming down to the same thing. Also coming down to the same thing. Okay, let's look at some failures. If we can see some failures, it'll be good. Okay. Yeah, this is what I wanted to show you. Look at this particular candle. Your order is intact. Kotak Bank have come down quite a bit. It's been below 25 for a few days now. And then finally on this hammer day, there's a hammer, beautiful hammer. It gives you a confirmation. Stochastics crossover. So rule wise, you buy above this, low as a stop loss, very small risk. The very next day it picks up, comes down a little bit. You remember I told you remember I told you that on the hammer, prices have a tendency to tease the low of the hammer, come very close to the low of the hammer and then pick up. Anyways, your entry would be somewhere here and you would have got a decent short-term move. This is not a bad trade. All right, this is clean, this is understandable. However, if you use the Donchian rule, now on this hammer day, where is your Donchian sitting? Your Donchian is sitting up here, then cools down here, then cools down here, which you enter here. Stochastics you would have entered here. This much extra you would have got if you had used stochastics. Now the downside of this strength of stochastics is many a times you would have got triggered and it can come down and hit your stop loss. If you're hit the Donchian, you wouldn't have got triggered at all. These are the two sides of both the concepts. We cannot have the best of everything. I'm just showing you two approaches. I request you just experiment a little bit and figure out which suits best for you. I have figured out one thing, that when the market goes oversold like this, I always prefer to see the candles drop, the size of the candles to become smaller and smaller, like it was in the first example we checked. This was the oversold condition, and see what happened after that. 3-4 days, the range of the market contracted significantly, which led to a nice breakout. So I always prefer, after hitting the aim, after going oversold, by the time I get the trigger, that is to buy, I would love to see the candles going smaller. This has got the support of a bullish Harami pattern here. You can see that very clearly, right? So this is one way that you can do. This can be done in any time frames. This can be done in the lower time frames. This is a 75-minute time frame. This is the 15-minute time frame. This is the same Kotak Bank. So you can come here, the 15-minute time frame traders. The trend goes down from this point. Then it gives a bounce back, 75.47. If you can see this green candle, this was overbought. To be sold below this low. Below this low. Sold, bounced back, consolidated, sold further down. This was your entry, this was your maximum profit, then gave a sharp bounce back to hit your stop loss. Now it depends whether you will get out at the stop loss, whether you will book profit at this level. This we will discuss now with money management. So this same logic can be applied in the 15-minute time frame as well. Very much, very so. So the same thing. Okay, right? Let me take a look at your questions. Is option scalping a viable option? Anything that can be done properly, anything that you are aware of, you understand, you have practiced, you sense that you have expertise, anything which you don't need anyone's opinion, but you can create your own opinion and you don't need to listen to anyone other's opinion, is viable. Don't do option scalping because someone in YouTube shared that he makes a lot of money by option scalping. Don't do swing trading because in some program I showed you that this is how I do aim and shoot swing trading. No, don't do that. You first understand the concept. You then exercise the concept. Then you understand whether it sinks in with your objective, with your psychology, with your philosophy or not. And then you don't need anyone else's opinion. So anything is viable as long as you can make it viable. Those guys who say that you don't make money in the stock market, or those guys who say that you lose money by buying options, those guys who say that etc etc etc, are those guys who are not able to do that. That's why they say, show me a guy who's making money in the stock market and says that no, you don't make money in stock market is gambling. Will anyone who's profitable in the market will ever say stock or trading is a gamble? Who will say that trading is a gamble and it's only for the big ticket players and retail always lose money? Who will say this? It'll come from someone who's not been able to do. Is not able to do it. That's why. So please, everything is viable as long as you know how to do it, how to make it viable. HDFC Bank, full aim and shoot for short in the derivative. Abhishek. HDFC Bank. Daily chart. I do not see aim and shoot short. Abhishek, if you are mentioning the daily chart, if you are mentioning it's a daily chart, then please try and understand the first and foremost thing, and this is a very common mistake. It's in an uptrend. The common mistake which I've seen everyone does is the first and foremost, they start looking at this end and this end of the chart, these two ends. Oh, this is an aim, it's gone above 75. Oh, this is a shoot, it's given a, so it's a short. That's not how I explained. That's not the objective. The first and foremost thing that I said and I requested is always to stay with the trend of the market. That's swing trading, to stay with the trend of the market, never sell a rising market. So the trend, how do we define the trend? With the 3 moving averages? It's positive. How can we do a short trade in a positive trending market? Contrarian traders do that. Selling a rising market is for contrarian traders. So this is not an aim and shoot short. Though there is an aim, though there is a shoot, where is the downtrend? It's an uptrend. It's an uptrend. It gave you opportunities here. It gave you a bit of opportunities here. It gave you an opportunity down here. This was a wonderful opportunity. This one. Aim, shoot, this difference, this bar's difference, and this was such a wonderful trade. So please, I will tell you this, Abhishek and everyone, this is a very, very common. Don't feel bad that you missed out looking at the trend. I have seen in almost all the classes, a lot of people, because you're always wanting to make money, you completely miss out the system. You completely miss out the process. Okay. Yesterday lecture, you mentioned that we can configure entire aim and shoot strategy on the query, but what will be complex as we'll have more than 15 conditions. I understood in the strategy, we are working on 4 conditions. That is moving averages 13 greater than 21, 21 greater than 34, RSI less than 25 Ogawa, and stochastic source crossover, which are the other conditions that we'll have to enter in. So the conditions, the way the query was built yesterday on the Spider software, after we did a run, it gave us a list of probabilistic traits. Those were not sacrosanct, those were not complete, because in few of them where the shoot was there, the aim may not be there. The aim may not be there. And so after you get the list, there was a certain degree of visual filtration. We always need to visually check whether aim and shoot both were satisfied or not, right? But it is possible with the same technical query to add on few more queries, 6, 7 more queries, and then make it as complete as possible. Means after we run, we will get only those stocks which are, yes, 100%, they had an aim and they had a shoot, both. It's possible, but then it is complex. I don't want to make things complex at the very beginning. Okay, that's the main difference. Donchian is a volatility tool, as like Bollinger. Donchian is not a volatility tool. Donchian is not a volatility tool. Donchian is a tool which shows us whichever time frame you choose, 5 period or 20 period, that particular period's high or low, high and low. Okay, so it's more of a breakout tool. But generally, we should tend to buy breakouts after range contraction, after the volatility has come down. So it's not necessarily a volatility tool like Bollinger, because Bollinger is using standard deviation. Okay, it's using a parameter of some degree of risk to calculate the highs and the lows. So Donchian is not a volatility. Can you please use Nifty 50 as an example? Of course, in this setup, if you wish me to use Nifty 50 as an example, so we can definitely do that. So you come here to Nifty 50, and then you can figure out yourself. This is one exercise which I request you to go through to do yourself. So Nifty 50 gave you a buy trigger here. And you would have got an exit on this day here. This was a good trade. Then you would have got another buy trigger here, which was very high. It doesn't make sense to take this buy trigger. Anyway, this is still in the money. And did you get a trigger here? 22. Yeah, this did not work. Yeah, so these are the 1, 2, 3 trades this system would have generated on the daily chart of Nifty since it went uptrend from this point. The first trade that we got was after a big sharp sell-off. If you had followed the Donchian,
it's 2 o'clock.
Thank you, Siri. You would have entered somewhere here, 950, and you would have out at around 780, 800, so around 150 points down. Then you would have got the next trade at 750, 11,750, and you would have got at 12,850. 11,750 so more than 1,000 points. Okay, so one trade 150 points down, second trade almost 1100 points up. So you're up 1,000 points on the Nifty. And the next one you got here, which I would not suggest you to take, but still in the money. So this is Nifty daily chart. You can feel free to visually cross-check. Visually cross-check in all the different time frames. Okay, this was, I think, asked by Bodhisattva, if I'm not mistaken. Using Marubozu with EMA is good with scalping. Maybe, as I told you, figure it out yourself. I do not use Marubozu in my approaches. With EMA, Marubozu, typical scalping method will be price should be above EMA, wait for a Marubozu, buy above the high of the Marubozu. This would be a typical way which any trader would probably go for. Couple of things. Marubozu Bodhisattva is a very rare pattern. You don't see Marubozus all over the charts all the time. So your trades will not be very frequent. So be careful on that. Is this aim and shoot strategy can be seen with Heiken Ashi candle layout? Yes, it can be, but when I change this candlestick chart to Heiken Ashi, there will be differences in the level of these indicators. The indicators and the readings will change. They may not give us the true picture. Okay, but can you use the Heiken Ashi and the same? The answer is yes. Indeed, you can do that. Of course, you can do that. You can put it into Heiken Ashi, but remember, because the Heiken Ashi closing prices are different, and all these indicators are calculated on the closing prices, they will change. So stick to the changed environment. Stick to the changed environment. And yes, you can use the same rules. For example, the 1,100 points profitable trade that you saw, you would have entered here, right? This was your entry point. This was your breakout point. And if you had followed Heiken, you would have exited low of 753, 744. So you would have been out here, which is more or less the same price where Donchian would have got you out. The same, more or less the same price. You can do this. Next. Is the HDFC Bank futures case what strategy to follow? We need to understand one thing, Samir and everyone, that every price point of every candle need not be a strategy. For example, the HDFC futures example that we found here, there need not be a trade at this point. There need not be, we are not. So this is my approach. It suits me, and this is what my logic is that, which I said yesterday also, is that we are not a scalper or a jobber who's trying to trade every minute, every second of a trading day. That he's trying to hit the iron irrespective of whatever temperature the iron is at. On the other hand, my approach is there are two important things which are needed to trade successfully in the market: patience and some guts. And patiently we need to wait for the right opportunity, and once the right opportunity comes, we need to show some guts. So that's my approach. That may not be everyone's approach. So what I'm trying to explain is, if HDFC Bank looks like this right now, there's no hard and fast rule that there has to be some opportunity here. Need not be. Maybe HDFC Bank offers some opportunity in the 75-minute time frame or the 15-minute time frame. Who knows? Maybe you look at the 15-minute time frames of HDFC Bank. Has it gone into a downtrend? Indeed, it has gone into a downtrend. Now, if it gives us a bounce back, will it offer us a aim and shoot shot? Yes, it can offer us an aim and shoot shot. Indeed, it can. So, need not be a trade always, all the time, but wait for the right opportunity and hit the iron when it's hot. That is my approach. That is what I suggest. Or else, it becomes really very difficult to trade. Means, to put it in simple language, you have to stand for something, or else you'll fall for everything. You have to stand for one particular or two particular setups or strategy, that when this meets, when this and this and this meets, that is when we will trade. So for example, if you look at most of the religious events on any religion, there'll be a certain planetary alignment. When this planet and that moon and that Saturn and etc. aligns, then this is an auspicious time for this kind of a ceremony. So you do not celebrate Eid or Diwali or any other things every day of the year. You only wait for a certain alignment. So that's exactly what I'm trying to say in the charts, is you wait for a certain alignment. Those alignments have to be in terms of trend, in terms of short-term momentum, in terms of range contraction. And then when the alignment is there, there is a higher possibility. That is when you execute. Can we use HDFC Bank current trend to write the put option? See, there you go. This is called an this is an impulsive nature. This is an impulsive nature to do something as if HDFC Bank is going to come down. We don't know. It may come down. It's going up for almost 6-7 days. The market is going up for 8 days. So of course it can, it should, it may come down. But are you going to participate in that, in this coming down? Then in that logic, you would have participated in this coming down, in this coming down, in this coming down, in this coming down, and whatnot. So stand for something, or else you'll fall for everything. At least in trading, we need to stand for something, or else trading would be random, completely random. Also understand, please, one thing, please, request. These two indicators down below, are very, very short term in nature. They are chosen for very small parameters, 3 and 4 period. So in a very small span of time, they can go from overbought to oversold and oversold to overbought, and they can do all funny things in a very small span of time. So don't base your trades based on short-term parameters. We are basing our trades based on short-term parameters here because we are aligning our trade with the long-term indicator, that is the trend. When we are aligning this with this, then it makes sense. But standalone, this doesn't make good sense. So please be careful. Please be careful. Always trade in the line of the trend. Aim and shoot use for consolidation phase. It will be difficult. It's always good that you've got a nice trend. Consolidation phase, Abhishek, will be difficult for all types of strategies which are looking to make money in trends. Consolidation phase, you can either, those who are directional traders, long short, can stay away. Those are non-directional, can sell, can create strategies on the options market and make use of decay of theta, and all those things can be done. Okay. So now let's go to money management. Okay, I'll take a look at your questions a little later. So now I'm going to take you to money management. To explain money management, I always use an Excel sheet. Is it under the mentorship traders? Okay, give me a minute. 25, 18, 17. So before we go to the Excel sheet, 5 important questions which anyone and everyone should answer to himself, you know, before you take a trade. These are the 5 important questions you need to answer to yourself before you take a trade. Question number 1 is, do I know which stock to buy or sell? That is, have you done your preparation enough to figure out which are the stocks or index which is satisfying your underlying condition or your strategy or your setup and looks good enough for a fall or a rise? It cannot be random. Let me compare this with, okay, I have no clue what's going to happen on Monday. I have not done any kind of homework. I open the television and in the media channel, some stocks are flashing. Some nice guy with wearing an Italian suit says buy this, sell this, and I'm trading based on the flow of the news and whatever I see on the channel. This is not your own intelligence. This is just your whims, which is trading, your whims and fancies. Just because you have some money and you want to trade, you're trading like this. So number 1, which stock are you going to buy or sell irrespective of what the market's going to do tomorrow? Have you decided that? Yes, that is question number 1. Question number 2, if you have decided which stock to buy or sell, then at what price to enter? That is your price of entry. This we have more or less understand. Let's say in aim and shoot strategy, we know that if we use the shoot indicator above the once we have the shoot crossover, we buy above the high. Or if we use the Donchian channel 3 period, then the Donchian channel high we will enter for a long trade, or a Donchian channel low will be used for a short trade. Number 3, at what price to exit? At what price to exit at a loss? That is your stop loss. So when you're taking the trade, before you place the order, do you know where is your stop loss? Yes, we have reached a stage where we know that where we can put the stop loss. So we know what risk we are taking in the trade. All these 3 questions, we are now today in a position which we can answer ourselves. Number 4. At what price to exit at a profit, which is essentially target. Now, I personally do not believe in targets, but then with the money management sheet, we will look into this 4th question, how to set up a target. The new concept which I shared with you today, the Donchian channel concept, you can use and write the trend as much as possible. Like we just, I think we did that with the Nifty. Where is it? Like this trade that we did right now, you would have used the Donchian channel to exit. You would have got an exit here. If you had used the Heiken Ashi candlestick, remember, then you would have got an exit here. So to some extent, we know the 4th answer, where to exit if we exit with the stop loss. But then without the stop loss, if we want to fix a target, let's say we enter here and then we want to fix a target here or somewhere up here. How can we fix this target? This we will discuss now with the money management sheet. And the fifth and also very important question is how much quantity to buy or sell. How much stocks or quantity to buy or sell. So now that you know that which stock to focus upon tomorrow, okay, now that you know that this is the stock, these are the stocks I'm going to go long for tomorrow, and this stock I would look to buy above this high, and this would be my stop loss. The last question that you need to answer yourself while placing the orders, how much quantity should I buy or sell? Very, very important, extremely important. And the answer to this question comes from the money management or bet sizing or risk management, whatever you may call it. Okay, now I'll walk you through the Excel sheet. This is a very basic, simple Excel sheet. I will give away this Excel sheet in your WhatsApp group after today's class gets over. So you need not create an Excel sheet yourself. The hard work is all done by me. You have to hear me out and understand the logic, the approach. Feel free to make changes to this Excel sheet. Feel free to add, delete, make this Excel sheet as per your style and preference. But understand my logic. If you trade based on this logic, if you trade based on the flow of this logic, I don't know how much money you will be able to make. That I don't know, because I've seen traders making 50% in a month, and I've seen them making more than 100% in like 4, 5 months, 6 months, and so on and so forth. So I don't know how much is there on the upside, but I know one thing, that you'll not be able to lose your capital, in the sense you'll not blow away your capital. There's a very, very low chance that you will blow away your capital. So what's the logic? Step by step. This money management sheet has 4 important tables. The first table is portfolio statistics or portfolio stats. The second table is possible trades. Third table is open positions or open trades. And the fourth table is booked trades, the trades which are closed and booked. Let's come to portfolio statistics, portfolio stats. Trading is a business. Approach it as a business. If you are serious about it, consider this as a full-time business, a business of businesses. Do not get into it because you want to make money or lots of money, because lots of people post a lot of flashy posts and videos that they have made so many lakhs in a month. You don't know what goes behind it. If they are all true, then it cannot happen in a year's time. Lot of experience, maybe 15, 20, 25 years of experience, and then these kind of fruits are coming to them. So approach it as a business. Any business requires a starting capital. A starting capital. A starting capital can be anything. It can be 50,000, 1 lakh, 5 lakhs, 10 lakhs. It can be anything. I have a video in my YouTube channel, and I've shared that link with you in my earlier classes, I think in our first or second class. How much capital is ideal to start trading? In the Indian equity markets, if you want to be a derivatives trader like futures, options a little bit, and you want to do positional futures, like you buy a couple of lots, you hold on to it for 1 night, 2 nights, then I sense 5 to 6 lakhs is minimum. If you're in the cash market, even 50,000 is fine, because you will buy 1 or 2 or 5 shares depending on the price of the share. Okay, so for all due respect, all due purpose, I've taken a starting capital of 10 lakhs. It can be 5, it's just a number. It can be 1 crore also. So I've taken 10 lakhs. The next row says WCS 3 lakhs. WCS is worst case scenario. Worst case scenario. Worst case scenario, I've taken the formula 30% of your starting capital, which means that if you lose 30% of your capital, if you're down 3 lakhs, then you will revisit your business. You will think of whether you are going to continue with this business or not. Would you take up the remaining 7 lakhs and think and do something else? Or will you continue to trade unprofitably like the way it is going? Now, how did I decide on 30%? See, 20 to 30% drawdown is what any trader will get in any proprietary trading desk. What does that sentence mean? The sentence means that worldwide, especially in Asia, you go to Hong Kong, Singapore, Mumbai, there are numerous proprietary trading desks where traders can go sit in a desk and trade on behalf of the proprietor. And there will be profit sharing. If you're profitable, you will keep a part of those profits. That will be your income. And the rest will be, of course, taken by the firm. There's no salary and all that stuff. It's not a job. But of course, that proprietary firm will have a hurdle or will have a threshold that, listen, don't blow more than 20% of my capital. Most of the time, this threshold is 20 to 30%, depending on the firm and their approach. And so I've taken 30%. Now you need to understand one more thing. No one likes to lose money. No one likes to lose money. But it also depends your emotional bondage, your emotional attachment with the capital. Let's try and understand this with the help of an example. Let's say you and your good friend, you were school buddies, you grew up together, went to the same college, studied commerce, passed out, did post-graduation. You are in 2 different cities now, and you're more or less doing the similar kind of a profile of some job in some MNC. More or less same standard of living, very, very similar standard of living. When you were in your early 20s, you decided that you would start saving money so that you can start your trading career later, after 5, 6, 7 or 10 years, depending on how much you'll be able to save. And you decided on saving 10 lakhs. The day I will save 10 lakhs, I will open my broking account and I will start trading. This was your thought process. And slowly, every month out of your salary, you saved a little bit by bit. And it took you a few years. And one day has come. There is, in a separate bank account, full 10 lakh rupees saved. Now you're ready to start your journey as a trader. Your friend, same profile, similar profile, did not believe in all these things. He always wanted to trade. He always thought, kabhi na kabhi I'll open an account and I'll trade. But he never had that urge, or he never had the discipline to save money. He saved a little bit, but it was never close to 10 lakhs. But to his pleasant surprise, he came to know that his great grandfather had recently passed away, and in his name, he has left 10 lakh rupees. All of a sudden, boom, in his bank account, he has fresh 10 lakh rupees. Now look at this, compare these two situations as an outsider. 2 guys, same age, same profile, 10 lakh rupees round figure in their bank account. Both of them tomorrow will start their trading journey, right? But if you look internally, who has more emotional attachment to that particular 10 lakhs of his? Of course, you, who has saved penny by penny and managed 10 lakhs. If you lose 10,000 rupees in your first trade, how will you feel? Your friend, on the other hand, if he loses 10,000 rupees in his first trade, how will he feel? Will the feeling be same? The feeling will not be good. This I understand. But the feeling will not be the same. Because this 10 lakh rupees that you have saved, it has took your blood, sweat, tears. But that 10 lakh rupees that he has not saved, he just got it. So he might be willing to blow off entire 10 lakhs. For him, the worst case scenario can be 100% of starting capital. For you, it can be 100%, it can be 80%, it can be 50%, it can be 30%. But don't make it 5% or 10%. 5%, 10% would be too tight. So give yourself some room, give yourself some space. If you're fine that, yeah, I save 10 lakhs, I'm fine if I blow out this 10 lakhs, I'm completely okay. Then so be it. Your worst case scenario is 10 lakhs. But you should have a worst case scenario. Okay. Next is risk per trade. Start off with 10,000 rupees. What is risk per trade? The trade that I'm going to take, each and every trade that I'm going to take, how much risk in rupees terms am I going to take on these trades? In other words, if I take the trade and the trade goes wrong, my stop loss is hit, I'm in a loss, then what is the rupee loss amount? What is that loss amount I'm okay with? I'm willing to take upfront. This I have considered 1% of starting capital. 1% of 10 lakhs is 10,000 rupees. So I already know if this trade that I'm going to take tomorrow morning, this trade that I'm going to take, if this guy hits its stop loss and I'm out in a loss, I'm going to book a loss of 10,000. This is predefined, pre-decided. I'm ready to take this loss, 10,000. Now, how did I decide on 1%? You can take 2, 3, 0.5%. Let's understand the logic. If I take 1%, my risk per trade comes to 10 lakhs. And if my worst case scenario is 3 lakhs, if this is my worst case scenario and this is my risk per trade, so how many consecutive wrong trades do I need to blow away my capital? I need 30 wrong trades, one after the other. 3 lakhs divided by 10,000. First trade, wrong, down 10,000. Second, down 10,000. Third, down 10,000. Like this, you will have to do 30 negative trades to blow out your 3 lakhs. It's really difficult to do that. However, there are few talented people, and if you're one of them, then definitely you should not be a trader. But trust me, making 30 wrong trades one after the other is very difficult. I had the opportunity to create many trading systems, check them, work on them, back test, front test, and all those fancy stuff. So we've seen 10, 12, 13 wrong trades one after the other that the system generates, and also 10, 12, 15, 18 positive trade that the system generates one after the other. It's possible. These are how the systems behave. When they go wrong one after the other, and then when it picks up, they also pick up really well. But 30 wrong trades seriously is really unattainable. So far till this point, with this, let's say you start your trading journey tomorrow with your very first trade. You take a risk of 10,000 rupees, you put the order, the market goes against you, damn, your stop loss is hit, you're down 10,000. How will you feel? Pathetic, bad. You'll curse the indicator, the setup, the book, the topic, the market, or whatever it is. You have to blame it on someone else. You cannot blame it yourself. No one blames him or herself. It's always some other person's fault. We are always right. Anyways, but the feeling is not going to be good. The feeling is going to be really bad. And the only way to kill this negative feeling because of the wrong trade is to make a right trade. There's no other way. You can drown yourself in a couple of pegs of alcohol, or you can go out with your friends, or you can curse anyone. You can do any damn thing. But trust me, the only way you'll feel better after a loss-making trade is making a real profitable trade. This is what negates the loss. This is what negates the feeling also. Now, when the feeling is so bad and pathetic and miserable, terrible, my first trade went bad, you will not be in a proper frame of mind to take on the next trade. You will be hesitant, maybe lack of confidence. A lot of emotional concussion will go inside you, and you will not be as focused as you were with your first trade. So what I request you to tell yourself is this, that listen, the first trade has gone wrong. So 1 down out of 30, I have 29 successive wrong trades to make till I blow out my capital. 29. So forget cribbing about my loss-making trade. Stop whining and complaining about the markets and the indicator. Move on to the next trade. I have 29 more wrongs to make. So rather than cribbing and whining and checking and rechecking the wrong trade and over again, it's important that you move on to the next. The moment you move on to the next, there is a chance of making. And if it turns out to be a make of a trade, that's a profitable trade, you will go back to that positivity, that framework, that frame, the mental frame of positivity. And so I always suggest you keep it, to start off with, you keep it 1%. 1.5 to 2% is still okay. If you're an experienced trader, if you've been trading for some time and a sizable risk is okay with you, you can increase it to 1.5 to even 2. 3 will be a little too much, and 1.5% would be too less. So if these concepts are new to you and you'll be starting off afresh, start with 1. See yourself, evaluate your performance, and then increase it or decrease it. I don't think decreasing would be a good idea, but increase it later when you've got a grip of your strategies, of your system, of the way you trade. We'll come back to these 3 rows a little later. Let's come to the most important table, which will make you or break you, the possible trades. Possible trades is your homework. Possible trades is your preparation. Possible trades is how well you come prepared for tomorrow's market. Tomorrow the market's going to open. So have you checked, analyzed the market that has gone by? Have you done enough scanning and checking of which are the stocks which are likely to give you a move tomorrow? And yes, if you've found a trading opportunity, have you marked those levels, those quantities? Are you prepared or not? Bottom line. Are you prepared or not for tomorrow's trade? Or are you just going to trade based on the whims and fancies of the price of the market tomorrow? So possible trades is essentially preparation. So you scan, you look for, let's say, aim and shoot, and you found out few stocks. You write the name of the stocks, whether it's a long trade or a short trade, what will be your point of entry and what will be your stop loss. These are the 4 parameters that you have to feed. Anything which is in a red ink on this sheet is a formula. You don't do anything here. You don't make any manual changes here. So let's say if you put Nifty and you say Nifty short, and you want to sell, let's say, below 14,000, and you want to keep 14,150 as a stop loss, something like this. So you got a risk of 150 points, and the quantity will automatically come to 70. So these 2 columns, you need not make any change. For a cash market trader, this is going to work beautifully, not a problem. For a futures market trader, something like this, which comes to 70, your lot size is 75, so you can go with 1 lot. If it comes to 60 or 50, of course, you will not be able to take it. Fine. So this completely depends on how well you are preparing yourself. You started off with a business with some capital. You decided your worst case scenario. You decided how much risk you're going to take per trade. And based on this, you come to this table wherein it will help you to decide the quantity based on the risk. This 70 is based on the risk. Let me show you how this is done in case you have not understood. In case you have not understood. Let's say you like a stock XYZ. You want to buy that stock. And your entry price is, let's say, 100 rupees. And your stop loss is 95 rupees. So how much is your risk? 100 minus 95? 5. And how much risk are you taking total? 10,000? How much risk are you taking total? 10,000? So 10,000 divided by 5? 2,000 quantity gets calculated automatically. What if the stop loss was not 95 but 90? The risk will be 10, the quantity will be 1,000. So this risk column and this quantity column has got a formula and it will calculate itself automatically. You don't have to do anything. All that you have to do is put in your best effort, ultimate best focused effort in finding out the stock, whether it's a long or a short, and your entry and stop loss. That's all that you have to do. Honestly, this is, I think, 95% of all your efforts should go here in this 4 columns, if not 99% of your effort. Now that you have prepared, now that you know these are the 3-4 stocks I'm going to focus upon tomorrow, these are the table of open trades, the trades which are open. Now this is something that you will be doing every day, right? This possible trades. This is a homework that you have to do as a trader every day. What am I going to hunt tomorrow? What am I going to hunt tomorrow? What is it that I'm going for tomorrow? This is your hunt. With this, you come to the market, and at times the trades will get triggered. At times the trade may not get triggered. You wanted to buy above 100, the stock never went above 100, it came down. So the setup got negated. So the trade never happened. This will happen. I think 50% of your anticipations will not play out. That's completely normal. In fact, it's quite funny that I've even met people who say that sir, there was an aim and shoot long, but ye to niche chala gaya. We need to understand an aim and shoot long setup is not a trade. A aim and shoot long setup or a moving average crossover or a hammer or whatever, these are not trades. These are possibilities. So there is no hard and fast rule that if there is a possibility, it has to go up. It can trigger and come down. It may not trigger, it can come down. It can trigger and go up. And as a trader, we will have experiences of all of these things. That's what makes the experience of trading. But there are few people who think that every day is going to be sunny and every day is going to be a party and every day is going to be a Sunday. So when life is not like that, how can you expect your trading experience to be like that? Anyways, coming back to the open trades. Simple, very simple. Open trades is a log of the trades which are open. The date of your entry, which stocks you have bought or you sold, your open positions. Is it a long trade or a short trade? This is primary for a unidirectional trader or a bidirectional trader, I'm sorry. But for a long only trader, you need not keep this. If you're a cash market long trader, you don't need this. You can remove this column because for you, every trade will be a long trade. Then the price of your entry. The QTY is a quantity which will come from here. Then the initial stop loss, the stop loss at first, when you first spotted the trading opportunity, at the very beginning of the trade, what was the initial stop loss? Then if you have trailed the stop loss, what is your current stop loss? POA, point of action, we'll come to this little later. CMP, current market price. And based on the current market price, your absolute profit or loss. Now, I will make them all negative little later, but first let me try and make them all positive. There's a reason why I'm going to do this. So your entry point is 1440. You've gone short. So let's make it 1340. Let's make it 1780. Let's make it 3200 and let's make it 150. Now I've purposely changed these numbers profitable. A summation of these absolute returns will reflect here in open profit and loss. I have not considered brokerages here. I've tried to keep this sheet as simple as possible. So brokerages are not considered. So open P&L, open profit and loss, the summation of that column is this. Okay. The fourth table is also simple, self-explanatory. Book trades or closed trades, the trades which you have closed. Your date of entry, date of exit, the stock, whether it's a long trade or a short trade, price, entry price, QTY quantity, initial stop loss, the stop loss which you took at the first, exit price, the price at which you exited. These are the parts that you have to feed manually, the black. Whichever is in black, you have to feed manually. Rest of it is in red, it will calculate itself on its own. It will calculate on its own what is the entry value, what is the exit value, and what is the absolute P&L. These two things will come at the end. Again, I'm going to turn them positive. So I've turned your booked profits also positive. The summation of absolute P&L, which is booked, closed, summation of this comes here, booked P&L. So your current capital is essentially a summation of the starting capital, how much booked profits you have booked, and also what is your open P&L. Few people may want to keep the open P&L, few people may not want to keep the open P&L. It's up to you. I leave it to you. Over here, I have considered open P&L, booked P&L, and starting capital together, giving me the current capital, which is 10 lakhs is now standing at 12,64,000. This is not confirmed 12,64,000 because the open P&L can increase or decrease, but this is anyways fixed. So this I leave to you to decide whether you want to keep open P&L a part of it or not. Depends. I will keep it. I'll keep it as a part of it. Now, you started off with 10 lakhs and with some good focus trades over a period of time, you've managed to turn this 10 lakhs to, let's say, 12.5 lakhs. This is decent performance. You're doing good. And next week, you will continue to trade. And you continue to take the risk of 10,000 rupees. Now, this is where a question mark comes, that I started trading and I decided I'm going to take 10,000 as a risk per trade. Now I have traded well and I have increased my 10 lakhs to, let's say, 12 lakhs, 12.5 lakhs. Okay. So should I continue to take 10,000 as my risk per trade, or should I take a little more risk? Can I take a little bit of more risk? Well, logically, common sense, yes, you can take a little bit of more risk because you're sitting on some profits, right? So even if you lose a little bit, it is not essentially you losing directly from your capital. You're losing from your earned profits. So in our next trade, we should take a little bit of more risk. But how much? 10,500 rupees, 11,000 rupees, or 12,000 rupees? This can be a simple function of current capital. The way your current capital behaves, the way your risk per trade will also behave. So I have changed the formula from starting capital of 10 lakhs to current capital of 12.5 lakhs. Risk per trade now changes from 10,000 to 12,000. So what does the system say? The system is allowing you, is providing you a greater amount of risk. This greater amount of risk will reflect in a greater amount of quantity. So as a trader, you will automatically land up taking a larger quantity only and only when your performance is good, because your risk is a function of your performance, and based on the risk you get the quantity. Now if you remember, when we started the sheet it was all negative, right? Exactly. If you turn them all negative, let's say after 2-3 months of trading you're not profitable, let's say now I'm going to turn them into loss-making trades. I'm purposely turning them into losses. Now you're down 1 lakh and your current capital is down. From 10 lakhs, now your current capital is just 9 lakhs. Now, automatically, your risk per trade comes down. Because your risk per trade comes down, your quantity will come down. So you don't have to think as a trader, please do not think about these parts any further. Only think about it once and focus only about this part. What is it that you're going to hunt tomorrow? Only this part. Because if you hunt well, this number will improve. If this number improves, this number will increase. If this number increase, you will take a larger quantity and a greater chance of making more profits. If this goes negative, this comes down. So it's gone into a self-preservation mode. It is not allowing you to take the same risk or higher risk. In fact, it's telling you take less risk, save yourself, save your capital so that you survive the game and don't blow it away. Risk as a function of capital, or risk, I'm sorry, as a function of your performance. You're a good trader. So it's very common, if you've noticed, in many sports you'll find this, mainly in crickets you'll find this. When a batsman is in form and he's scoring very good runs, he'll score 100, then he'll notice after scoring 100, he will swing his bat like wildly. And then for all due purpose, for all due reason, even by swinging his bat wildly, even he might get a lucky 4 or a 6. Why does he swing so wild? Because he has already created a value for himself and his team. Now, even if he gets out, he doesn't mind. But he doesn't behave so irresponsibly at the beginning of when he got into the pitch. So when you get into the pitch, you behave responsibly. In this case, you need to behave responsibly all the time. You cannot behave irresponsibly, because a cricket match has a certain time period. It will finish after 50 overs or 20 overs. This, my friend, is never going to finish. So don't be irresponsible in this case. So the objective of this Excel sheet, number 1, is have a risk-oriented approach. Define the risk. Focus on your stocks that you're going to trade. Based on that, the system will derive the quantity. You don't have to derive the quantity every time. Every time you find a new stock, you don't have to figure out how much quantity. Let this decide for itself. You only decide it once and stop it, and only focus on the hunting. That's it. Next part comes is point of action, POA. Now, this is where the targets come into play. Let me share an example with you. Let's say you entered a trade at 100 rupees. The stock price was at 100. Okay. And your advisor or someone on the television told you or told everyone about the trade, that buy at 100, stop loss, let's say 95, and target, let's say 112. Like a typical advisor or anyone associated in the advisory business in any financial market will give a recommendation. Buy at 100, stop loss 95, target 112, or target 1, target 2, target 3, and all that. Now, you bought at 100. Now, till 100 was reached, like till the point you did not buy, whether to buy or not at 100 was 100% in your hands. It was in your control, whether you want to buy at 100 or not. But then you decided, let's buy at 100. So you place the order and 100 does come and you have bought. The trade is on. Till the point the trade is not on, your psychological behavior towards the trade, and when the trade actually gets on and it's live, your psychological behavior will be very, very different. Very, very different. Okay. Just give me a minute, please. 1 minute, please. I just need to mute myself for a second. Just 1 minute. Hold on a second. Okay, sorry for that. I might have to mute myself for a couple of minutes more, little later, but I'll try and keep it as quick as possible. So your psychological behavior pre the trade and during the trade are very different. Those who trade will know what I'm telling. Is the way you behave, the way you look into the trade will be different. Now what happens when you have the stock, let's say it has picked up from 100, 102, 3, 4, 5, 6, 7, 8, come close to, let's say, 108. Fine. So you're looking good. You're looking good. You might probably have trailed the stop loss, if at all. But you know what happens is your mind, before even you took the trade, your mind subconsciously had recorded that 100 is where I'm going to buy, 112 is what I will get, and 95 is where I will feel bad. Feel bad point, feel good point, entry point. This is something that your subconscious mind already knew of. That's not a reality. It's an information. And that's why any expert or any advisor will always give you targets which are greater than your stop loss. He'll always give you targets which are greater than the stop loss, or else you will not buy it. You will not bite it. If you see a fish in a pond or in a lake or in a river or in an ocean, will only take those baits which he wants to take. So if someone tells you 195 stop loss and on the up 105 or 104, you'll say, what's the point? I will not take it. If someone says buy at 100, downside 95, upside, I don't know. It can be 105, it can be 108, it can be 125, it can be 200. I don't know which is the upside, but I can give you only entry and stop loss. Will you think people will buy it? No, people will not buy. People will only take these kind of storytelling. Because when you listen to this, when you read this, when you hear this, your mind feels good. Okay, this looks good. 12 rupees on the upside, 5 rupees on the downside. Looks good, right? As if you have already booked 5 rupees loss, as if you've already booked 12 rupees profit. Who said that 12 rupees will come and 24 rupees may not come? Who said it will be 5 rupees negative and not 1 rupee negative? We don't know. So what happens is the stock, after it trades at 100 and it picks up, it can go to 4, 5, 6 or 7, and then it can start to come down a little bit. Let's say it starts to come down from 106 or 7 like this. Most, I'm not generalizing for 100% of the traders, but most of them will not do anything, because most of them have their eyes, their expectations at 112. And so from 106 it starts to come down, and if it comes to 100, definitely you're not going to do much. And if it falls further down to 95 and hits your stop loss, you lose this much. But let's say at 106, if the chart had given you some clear signs, some clear signals that I'm getting weaker, the momentum is coming down, shouldn't you have trailed your stop loss? Shouldn't you have booked some partial profits? So what I'm trying to explain with this example is trade as per the merit of the chart and not based on your expectations. We all expect profits. There is no single trader who does not expect profit from his trade. But what we expect and what we get, there's a big slippage, there's a big difference. You don't have to go too far. Look at yourself, whatever you've expected from yourself all these years, how much of those plans have actually fruitified? How many times you've made plans to go to the gym and lose so many kgs, or how many times you've made plans to learn a musical instrument, or how many times you've thought you'll do this with some golden plans and preparations, and then down the line in the future, what has been the final outcome? Don't go out too far. Just look at yourself and tell me, do they always meet? No, they don't. That does not mean that we should not expect, until and unless we have some expectations, where we are emotional creatures, right? We should expect and work towards it. That's exactly what I'm trying to tell you. 112 expectation is not bad at all, but don't let it be a psychological trap. If it goes to 106, 7, 5, and the chart shows that no, this is not feeling good, this is not looking good, so don't tell yourself, no, don't worry, hold on to it, 112. Don't do that. Trail your stop loss, protect your open profits, book your profits, take some small profits. A small profit is always better than a large loss. And so I always look at targets as a trap. And so I personally do not believe in any target. No targets. Because I don't want to tell myself there's an upside cap. So how should we deal with this? What is that POA? POA means the point of action. So 100 with 95 as your stop loss. This difference is 5. This is the risk that you're taking, or this is the amount you're willing to give to the market when you're placing the order at 100. Just give me a moment. I just need to come back in 2 minutes time. Yeah, I'm sorry for that. So when you're placing the order at 100 with 95 as your stop loss, what are you trying to tell the market? You're trying to tell the market that, listen, I have done my homework. I think that this stock has more probability of going up than coming down, and I'm willing to take a bet, a risk on this. If I go wrong, I'm going to give you 5 rupees and not more than that. This is the risk I foresee in my trade. I foresee in my trade. So if I go wrong, you take $5 from me. That's it. Now I'll buy at 100 and let's see how much you can give me. This is more or less the conversation, the communication between you and the market. And then the 100 comes and you bought, and then the fun begins. Then from 100, let's say it does all its funny part, and it finally starts to pick up. What happens at 105 or 105? 105. What happens at 105 is the risk that you took and the reward that the market is giving you is now the same, which we call as 1:1. So now the market is essentially allowing you, giving you exactly the same amount what you were willing to give the market. You'll agree to this? This point I call the point of action, not target, the point of action. Point of action means some action you have to take, you need to take. What can be these actions? First action that you can take is book full profits. If you're fine with the profits, you book full profits. So be it. The sum action. Number 2, book partial profits. Book, let's say 50% of profits and trail your stop loss above cost. Number 3, trail stop loss above cost. Whatever it is, you have to take some action. Either of these actions leads to profit protection, means the profit that you're seeing, that the profits that the markets are giving you, you have to pay respect to this profit and protect it. Protecting can be taking out the profits. Protecting can be booking some and letting it ride for the rest of the movement, or keep as it is and trail the stop loss. Let's see how far it can go. And now with that logic, 105 can shoot up to 112, 120, and who knows how far can it take you. Did we know at this point of the time on the chart of Nifty, when we entered, did we know it was going to give us 1100 points? 1100 points on Nifty is not small. Did you know it's going to give you 1100 points? No one knows. So who knows, it can give us 100 points. This took away 150 points. This gave us 1100 points. So that's exactly the point. Who knows where it's going to go? So why worry? So why even put a number to it? On the other hand, let's use the slab. Let's use the 5 point, the initial risk which I took. So let's put 105. Let's put it at 110. Let's put it at 115. So every movement of 5 points, I'll take some action. Now, there is no hard and fast rule you have to do any one of them all the time. It depends on your performance. For example, very critical, very common example. Your trading is going really bad. You've got some one after the other wrong trades because of your own whimsical fancies, psychological errors. Finally, tomorrow you get a good trade. After 5-6 bad trades, tomorrow you get a good trade in your hand. Do you think you will want to ride the trend? No, you will have an inclination. Yeah, chalo, let's book some profits. Let's reduce the losses. You reverse the situation. Let's say you're sitting on very good profits. You had a great run over the last 1 week. And the first day on Monday, you got a good trade and it's also showing some profits. You're sitting already in good profits. What would you like to do? Okay, let's trail the stop loss. Let's see how much more profits can I make, because you're already sitting on good profits. This also depends on stock to stock. You know, stocks which moves very fast in either direction, something like, let's say, Ultra Chemco in the futures market, Ultra Cement in the futures market. It does move quite wild. Biocon, Amar Raja Batteries. These stocks give a quick, sharp move, and they're also quick enough to retrace also. Tech Mahindra, classical stock, which does this. So you might be agile and quick enough to book or partially book. But then if it is, let's say, an SBI or a Bank Nifty, or let's say Nifty or a Reliance, then okay, fine. I know this stock is not, this stock does not misbehave. And if it's giving me some profits, it can rally further. So let's trail my stop loss. Let's see how much I can squeeze out of this move. So there is no one rule that you can assign, but there has to be either of these three. Whatever it is, you have to do something at that point. And so on this Excel sheet, there is a section called POA. POA is nothing but if you enter at 1440, it's a short trade, it's a Reliance short trade. If you enter at 1440 with a stop loss of 1460, which is 20 points risk, then your POA should be 20 points less than 1440, that is 1420. That's POA. And the last part of this Excel sheet is RRR. RRR is nothing but how much you made vis-a-vis the initial risk that you had taken. In this example of the first one, Nifty, the risk that was taken based on the initial stop loss, the risk that was taken was 7,500. But then you booked a loss of 15,000. So RRR is nothing but how much final profit or loss you made divided by how much did you decide to take the risk. So you took -2, means 2 times more loss. 2 times more loss. However, if I change it, let's say entry price was 11,600 and I make it 11,800. Now you made 15,000 profit. So your RR will be +2, which means you took 7,500 risk. You made 2 times of it. So with this 2 means you took 1 rupee risk, you made 2 rupees. This -2 means you took 1 rupee risk, you lost -2 rupees. Is that okay? The summation of these is called expectation. This number has to be a positive number. This number has to be a positive number. An expectancy of -2 means if I give you 1 rupee, based on your performance, you will lose 2 rupees. On an average, you will lose half a paisa. This is what it means. So for a trader, expectancy needs to be always positive. It cannot slip into negative. Higher the number, better. The average RRR is summation divided by the number of it. That's the average RRR. Your objective as a trader would be to make this one number. So let's say there are many traders who are even today who shares this sheet with me, right? In fact, in my YouTube channel, if you see the video with, I think it was with Karan and the other person who lives in UK, I think both of them are still using the same sheet. So all that I need to see is, I don't need to see how many trades you have done and etc. etc. Yeah, all that is needed to see is this. That's it. Or an average RRR. These two numbers is just perfect. An average RRR of 0.5 minus 0.5 means if I give you 1 rupee to risk, depending on your past performance, you will lose 50 paisa. Right? So this is the Excel sheet which I've created. This is the logic of the sheet and the money management approach. The idea is, the foremost idea of this sheet is the 5th question. How much quantity to buy or sell? That is the key idea, because we don't want to decide on the quantity on our whims and fancies every time we get a trade. We don't want to do this. We want a certain rule-based approach based on which we would like to decide on the quantity. Okay. Make use of the sheet, change it as per your requirements. What should be our process in stock selection? One, we have aim and shoot, but what should be our focus? Like Nifty 50 stocks, you can start with the Nifty 200. If you want a larger universe, deep, then I would suggest Nifty 200 is fine. If you're a derivatives trader, then of course the FNO universe should be your should be your universe. That's it. Nifty 50 is a good quality universe, but you may not get trades every day. Okay. Is SL hit and then price moves so we can make position again in certain price? Yes, you can. Yes, you can, provided you have a logic to enter. You bought a stock, it went up a little bit, then came down, and your stop loss is hit. You're out of the picture, right? Right. Now, Abhishek's question is, if the price comes back again, can we enter or not? So my answer is, yes, you can, provided there is logic or rational enough for you to buy. Do not get into again out of revenge. It will never work. You will buy again if the logic, the rationale of your buying is there. If let's say you're buying based on aim and shoot, and after your stop loss gets triggered, if again it creates another aim and shoot, then there is a rationale of you to buy again. But just because, oh, my stop loss got hit, now my buying price again comes, I'll buy again. That's not a good idea. That is based on emotions. Can you share Excel sheet in the WhatsApp? I think you missed out in the session. I clearly mentioned, yes, I will share the Excel sheet in the WhatsApp group before I started talking about the Excel. So I'll take a break now, and when we come back, the last few minutes of the sessions will be discussed. We'll discuss on trading psychology. So it's 10 minutes past 3. I'll take around 12 minutes. So 2022 around 23 minutes past 3 o'clock, we'll start the session talking about trading psychology. Thank you. All right. The last session of our theoretical classes, the concept of trader psychology or mentality. Before I go and talk about my little bit of understanding about trader psychology, let's try and do this case study, a hypothetical case study. This is not going to happen for real, but let's say, and I would want every one of us to participate in this hypothetical case study. That is, let's say Tuesday, my contribution towards our program comes to an end. I hope you have understood the subject, the philosophy of the subject, the pros and cons of the subject, where people go wrong because of probably over anticipation that they have learned, so they will make money. It doesn't work that way. You've got a setup which is logical enough. If you have a software, you can scan it or visually scan it. You've got a money management Excel sheet based on which you can find the quantity. You can stay disciplined. So with all these understanding, let's say, after Tuesday's class gets over, let's say I give you 5 lakhs account size each. And let's say every one of you get a new fresh account. Let's say I'm just taking for a hypothetical purpose, a Zerodha account. Okay. Every one of you are also given the Spider Iris Plus software for 30 days free. Every one of you. Every one of you are requested that you should only trade within the Nifty 200 stocks and not beyond or outside that universe. Everyone should focus on the aim and shoot strategy only. You should only focus on the daily and the, let's say, the 75 minutes or the hourly charts. Okay, so so the amount in each of your account is the same amount. The cost is the same, it's the same broker. The software, the platform of trade identification and trade execution is also the same. The universe of stocks that all of you will be focusing on is the same. The strategy is also going to be the same, and the time frame that you guys will trade will also be the same. This is a task that, let's say, is given to you after Tuesday for a period of 30 days. So you start from the 6th of January, and on the 6th of February, we meet again online after a month, and you have traded for this 1 month based on these 6 pointers. Is shorting options allowed? Shorting options, of course, is allowed. There's selling options, right? Let's say if this is given to you, if this kind of a structure is given to you, and we meet after 1 month on the 6th of Feb, and I request you that when you come and meet me online on the 6th of Feb, before that, please email me that P&L sheet, that 1-pager sheet which shows at the end your ledger what is the amount of profit and loss. You're going to email it to me. Now, my simple question to all of you is this: will this rupees P&L amount be exactly the same for each and every one of you? Ketki Aditya says no. Shobhan says no. Sarup Saurav says no. Anirban also says no. Atul says no. Anil says probably yes. So it's not going to be the same. It's never going to be the same. it's going to behave very, very similar to a bell curve. It's going to behave very similar to a bell curve, where most of the performances will fall under a certain range. Few of you will do exceptionally good, and few of you will do exceptionally bad. Majority of you, 60-70% of you, will fall within a particular range. This is how it's going to come out. The final outcome is going to come out like that. So if you agree to this, if you've understood what I just asked, so there are 3 M's to trading: money, method, and mind. People say that people who have more money are successful in the market. People with lesser money cannot make money in the market. That cannot be true, because in this experiment, all of you had the same money. Then there are other people, and these are all people who have not made successful money in the market. That's why they crib. And then they will say that, okay, these guys have more expensive softwares, and they know some strategies, and they have an order flow of 10 people, 20 order flows, etc., etc. So they have a secret method which we don't have, and that's why we don't. That cannot also be the case, because in the experiment right now, all of you had the same method, the same software, and everything was the same. The only reason why the performance was different, keeping in mind everything was same, is the mind. These are all external factors. This is an internal factor. The broker, the amount, the money in your account, the software, the platform, the universe, the strategy, the course, the book, the video, the time frame, all these comes under the domain of externalities. And there are n different ways to have different externalities. They do not guarantee you any return or success in trading or in life. It is 100% internal. With the best of the softwares and the best of the courses and with lots of money, you can lose. And with a very small limited amount and with just an Excel sheet and a small free of cost software, you can still be a consistent trader. It's all internal. It's 100% internal. So I had personally the privilege, the experience, the luck, whatever you call it, to interact with many people during my stay, when I used to live in Mumbai. So I had interacted with many fund managers, with many people in and around the city. And I had once met a trader who was also a grain merchant, and he used to live close to Masjid, and his grain merchant store was in Koparkhan, close to that area in Navi Mumbai. That's quite a distance. Those who are from Maharashtra will understand what I'm saying. And he was a very active trader himself. He used to take the trains, the local Harbour Line train, every day. He was one of my known persons, related uncle or someone. So he used to trade in multi-crores, and he does exceptionally good. This person cannot speak English, by the way. He is not very good with softwares or technicals, nothing. He just looks into the price. He just looks into the platform, the blue and red screen. He's got a sense, the pulse of the market. He trades in multi-crores, and his portfolio is in multi-crores. He every day wears the same Safed kurta pajama, and that's it. Very, very simple, humble, down to earth, very normal guy. And if he passes you, you will not even bother to even look at him. No fancy watches or clothes or cars or Instagram post of showing and bloating and bragging how much profits. Nothing, nothing. So it's all internal. It's all internal. It's 100% mental. Those of you who think that doing a course will make you successful, you'll become consistent, profitable trader, you're wrong. If you think that if you get 50 lakhs and you get a software and you buy that book and you go to US and do that course, you'll become successful, you're wrong. It's how you utilize that information. That is the most important thing. A simple amen shoot is good enough. A simple Donchian channel breakout is good enough. A simple price action is good enough. A simple hammer is good enough. Or nothing is good enough. It completely depends on how your mind perceives it. So this is a very psychological, tending towards spiritual kind of a session. And I generally do not try to, just hold on for a second. I will be closing my screen and I need to figure it out. So what I was saying is art and science of trading. Yeah, got it. So, so this particular session, everyone, tends to is psychological, is talking about the mentality, is talking about the mind. So it tends to go towards spirituality, and it might become a little not so interesting for you, for few of you, depends on how you take it. And so unlike the previous sessions wherein I always scribble and write down and I explain, in this session I always use a PDF which I have jot down. It helps me to keep in track, because when we're talking about the mind and experiences and trading experiences, I can go on like for hours, and it can land up being very, very boring for few of you. It can. It may be very, very interesting for few of you. So I'll keep it short and I'll walk you through these pages. 100% is the mind. 100%. It's got to do with the mind. 250 people get enrolled in the 2 years PGDBM course in IIM Ahmedabad. After 2 years, all the 250 students graduate. Do all the 250 students get the same package? No. Handful of them get the best of the package, which will be in crores. Handful of them will not even get a 10 lakh or a 15 lakh package. Yes, they'll be down there. Well, no one will be even talking about, and the chunk of them will get a decent package. This is not true about IIM Ahmedabad. This is true about any B school. This is true about any college. This is true about any school. Look at yourself when you were in the 5th standard. Look at yourself when you were in the 10th standard in your college, etc., etc. All of you went to the same school, same college, same professor, same books, maybe the same tuitions also. How come one gets such a good mark? How come the chunk gets more or less average mark? And how come one gets like pathetically low marks or package or money or whatever you call it? It's nothing to do with the method. It's nothing to do with the money. It's got to do with the mind. So there is a take in the word mistake. Whenever you're making a mistake in trading, there are a few classical mistakes which people make. Not having a plan of action is a classical mistake. Come prepared. Go to the market tomorrow as well prepared as possible. The more prepared you are, the better are your chances of going right. The better are your chances of making money. Try it for a month. Whatever I say, don't even believe me for a single bit. Just try it. See yourself. If it works, then you don't need anyone to confirm. So try to prepare yourself to your best abilities, to the best of your abilities for a month's time. Not one day. One day is too less. One week is too less. At least a month or two. Just going to the gym for one day is not going to make you shredded. It has to be for 6 months regularly. And then only you start to see those definitions. Then only do you start to see those results. So have a plan of action and execute that plan of action for a certain period of time. Please have a plan of action. Which universe, which strategy, which time frame, how much risk appetite, how much quantity should I take? It should be well processed, well defined approach. Plan a trade. So once you've planned the trade, this is what I'm going to trade tomorrow. All that you have to do tomorrow is trade the plan. This is my plan, this is my capital, this is my risk per trade, this is my strategy, this is my time frame, this is the stock under my radar, this is my point of entry, this is my exit, this is my stop loss, this is the risk I'm taking. That's it. I'm ready for tomorrow. All your planning is done. Tomorrow, what do you have to do? Just trade the plan. You don't have to look for a trade. You don't have to scalp or job or do any unnecessary things. Trading is done outside trading hours. Trading hours is just for execution. Trading is done after trading hours. Also try and figure out that did you make any mistake or not. Mistakes are essentially not sticking to your plan of action. Overriding your rules at times is fine, but if you continue to do it multiple times, it increases your risk of ruin. Risk of ruin is very high when you're breaking your rules multiple times, over and over again. I had this tendency to do this. I am the kind of nature of a person that I tend to do this. It takes time. So try and figure out that to what degree are you managing to stick to your plans. And if you've managed to make a mistake, let's say if you made a mistake, that's okay. A mistake would be something like not sticking to your plan of action. You decided this will be my stop loss. You removed the stop loss. You did not trail the stop loss. These are all mistakes. You thought that this is a good price to book some profits. That price came and you did not book your profits. This is a mistake. A mistake is essentially you decided upon something, and you not living up to it. That's a mistake. A classical mistake that every one of you, most of you probably make, is you put an alarm at 6 o'clock in the morning and you wake up on the 7th snooze or the 6th or the 3rd snooze. That's a mistake. If you decided you want to get up at 6 o'clock, you might as well get up at 6 o'clock. So not living up to or not executing what you had decided for yourself, not for your neighbor, for yourself. That's a mistake. In trading, that's a mistake. So let's say if you're making this mistake multiple times, once or twice is fine, but multiple times, then do one thing. Sit down quietly, figure out under what condition are you making or breaking this rule. Then work at it. An example would be, let's say you wanted to take up trading because you're an IT professional and IT industry changes dramatically, or you are going to retire in 2 years' time and you don't know what to do with your free time and some extra money that you'll get. So you want to take up trading. Let's say you're new to trading. You join a course in Elon Markets, you go through some program, you read a couple of books, you've taken a software, you understand a couple of strategies. You're just dabbling here and there. It's okay. You're in that kind of a state of mind. Then actually you get into some real solid trades. And let's say over and over again, whenever you put a trade and you put a stop loss, whenever prices comes close to your stop loss, you start to get sweaty palms. You start to get worried. You don't like that feeling. You don't like the feeling of booking a loss, and you tend to remove the stop loss each and every time. And each and every time after removing the stop loss, a time comes when you don't even put the stop loss. You decide upon an entry point, you decide upon a stop loss, but when the time really comes to use the stop loss, you don't use it. Is that a mistake? It's a mistake. Now that's fine. That's completely okay. But then what will happen is eventually 1 or 2 trades will fall below your stop loss so much, so significant that those 2 trades will take away all the profits of the entire year. It doesn't need 2 or more than 4 5 trades. Just 2 or 3 is good enough. So if that is the case, it's completely normal. I'm not saying that you're doing something very bad, don't do it, please. I'm not saying you all these things. What I'm telling you is, don't go against your nature. Sit down and try and understand. If this is what you're doing repetitively, then my nature is such that I don't like to book losses. Looking negative amount doesn't go good with my system. It bothers me. It disturbs me. I get agitated and it reflects in my other parts of my day-to-day life, maybe my professional life or my family life. Why will I allow a 15,000 or a 50,000 loss in a trade to affect my relationship with my family members or my friends or my professional life? Think over it. If that is the case, then maybe trading is not the right thing for you. Maybe you should look into investments where there is no stop loss. You should look to buy stocks and create a long-term portfolio. Maybe it will work for you. Maybe you will become a very, very good profitable investor. But you're getting attracted towards trading because it is fancy. It is short-term, big-term profits. You're getting attracted towards it, but maybe it's not right for you. It might be fancy, it might be attractive, but who says that everyone can become a trader? So removing the stop loss is not the mistake, but sticking to trading and keeping on removing the stop loss, that's a mistake. So you need to figure out why and under which kind of conditions am I breaking my rules. You put this alarm at 6 o'clock, but you get up at 6:45 after the third snooze. And you keep on doing it for month and month and month, and you realize one day at night when you're putting the alarm at 6 o'clock, anyways, I get up at 6:45. What's the point of giving the alarm at 6 o'clock? So think over it. Thought process, it's a small brain, but it takes up almost 30% of our energy. It's a one lump, I think, couple of kgs, not more than that. But it's an energy guzzler. It takes up a lot of our energy. And we are continuously thinking of a million things in a day's time. As I take this class, this session, you're probably listening to me and your attention is maybe 5%, maybe 15%, not more than that. Rest of it, you're checking your Instagram post. Few of you are probably watching something else parallelly, maybe reading something, maybe probably dozed off for a nap. A lot of things happen. So our mind is continuously jumping from one thought to the other, and it's very difficult to focus it, to have a proper focus. Now, if you compare yourself today at whatever age you are right now, and you compare yourself with a younger version of you when you were, let's say, 4 years old or 5 years old, you would notice that most of you were much more chilled out when you were younger, much more full of life when you were 5 years old, much more crazy and entertaining and had fun and did not worry so much when you were 5 years old compared to your current age. Why so? The main reason behind this is not responsibilities, not social responsibilities, etc., etc. No, no one told you to take this social responsibility. It's essentially what I feel, it's my personal belief, is the quantum of decision making. When you're 5 years old, you did not decide what you'll have for dinner or lunch or breakfast. You did not decide what you're going to wear after your shower. You don't even decide where you want to go out. Your parents took you. But as we grow older, the quantum, the amount of decisions that we take, one at a conscious level and two at a subconscious level, is huge. Is a huge amount of decisions are being taken each and every moment. And as the amount of decision becomes more and more, a decision needs to be taken, and the decision can lead to a success or a failure. The decision that you and I take in our career, should we take commerce or science? Should I take this course or that course? When you decided upon this course, should I marry this person or that person? If you're if you had to take a decision like that. You understand what I'm saying? Should I buy this toothpaste or that toothpaste? That is also a decision. Now, the problem with decision making is this: it can backfire. If the decision goes bad, it might prove negativity. It can lead to, so in trading, what happens, it leads to loss of capital. You buy the wrong toothpaste, you don't like it, then either you have to live with that bad toothpaste for the rest of the month, or your money goes waste and you go back and buy a new toothpaste. But there is some loss of capital, or some degree of a loss or a negative, we can attach a negative attribute to it. So the 5-year-old does not decide so much. You and I decide a lot. Now you come to trading. Now you come to trading, and you imagine and try and understand the sheer amount of decision that a trader needs to make. Huge. Which stock to buy? Is this the right strategy? Is this the right market? Price, quantity, targets, stop loss. All these things can be decided before the trade in a much more stable manner. Excuse me. All these decisions can be taken in a much more stable manner before the market opens or before the trade is on. But trust me, once the trade is on, the decision-making capabilities drop significantly. When the trade is live and your P&L is jumping up and down, you being able to take a decision is not that easy. It's very, very difficult. So the main thing which decides your success as a trader, and the main thing which also decides your success as a person, is the choices we make. The choices will lead to consequences, right? So if the consequences is a function of my choice, to a lot of extent, yes, then what am I using to make this choice? What am I using to make these choices in my life, in my trading? What am I using? We're using our intellect. We're using our mind. And this damn mind flutters. This moves fast. So what can we do about it? I'm going to quickly go through these sections and then I'll come to your questions. So there are 5 sensory senses that we have. We see, we hear, we taste, we smell, we touch. Whatever we have gathered information today till date has come to us through these one or all of these windows. We can call these windows. We have these 5 windows through which we perceive, we understand, we record things. How does a mango look like? How does a glass, when it breaks, how does it, what kind of noise it makes? How does a mango taste? How does a mango smell? What's the touch of the skin of the mango? Few things we cannot taste. We don't know how the taste of a glass is, but we can hear how our glass breaks. We can see the glass. We cannot smell the glass. We can touch the glass. So either with all or few, this is the only way, and the only way in which you and I, we know of things. We record things. In this, you will notice that I have personally put in a mark, an arrow in the taste or the mouth. Now, the 5 sensory senses, I figure that the mouth is extremely important. Not the taste of food. It should be the mouth, in the sense what we say and what we eat. So what goes inside the mouth and what comes outside the mouth is extremely important for me. This is 100% in our control. What we eat and what we say is 100% in our control. And I think it's very, very important. I've seen in my personal experiences people abusing the market, abusing Nifty, because he made a lot of loss that day. It does not mean that you're going to slang the market. You're going to abuse the market. Or not just the market. When you are angry, you abuse someone, your friend or family. Later on, you come back and you might have said, I was angry, I'm gusse mein tha, maaf kar. You understand what I'm saying? But it doesn't help, right? Once words come out of your mouth, they come out. So all that I'm trying to tell you in these slides is very simple. Decision making is very, very important in our life, especially as a trader. And we perceive things through these senses. And if we perceive things through these senses and out of which we decide, we should be very, very careful of our senses. Yes, we should be very conscious about our senses. So self-talk is very important. This is something which I believe in a lot. Why, let's say you had a bad day in your office or in your trading or anywhere, you don't have to jump into conclusions. You just can self-talk yourself that why am I getting so bothered? You get an answer. Okay, you're getting bothered because of this person said this. Okay, why did this person say this? This person was mad at me and he said this. Did he say the right thing or the wrong thing? No, man, he said the right thing. So there's no point of getting angry at him. He probably said the right thing and such karwa hota hai. You understand what I'm saying? So self-talk will bring you out of such whimsical fantasies about yourself. Do that. So hearing is very important. Vision is also a very important thing. You can vision a new car or a new house. Okay. Don't put a picture or a poster of that car or house on your wall and you expect you will get it. No, it doesn't work that way. You need to work towards it. But yes, having a vision that this is how I want to see myself does generally work. Stress is something that comes like a byproduct of the market, or as a trader cannot accept losses, especially one after the other. It becomes very stressful. Drawdown is losses one after the other, a period of drawdown. Flow of information is too much to handle. So much information, so many apps, so many websites, so many notifications. I don't know what's going to happen tomorrow. Constant factor of uncertainty. What's going to happen tomorrow? Taking profits too fast and the markets go away and not being able to get back into the market. The fear of getting back into the market. In whichever way you look at it, stress is something which is going to come towards you. You are going to experience this no matter how good you are or no matter how bad you are. It's not that you should try to reduce the stress. Don't try to reduce the stress. It doesn't work. It's like when people say empty your mind. Your mind is thoughtless. Complete bullshit. The mind cannot be empty. The thought that there is no thought is in itself a thought, that I am not going to think of anything. Okay, I'm not thinking of anything. That self in itself is a thought. So it is impossible. So in that same logic, you cannot say that, oh, okay, I'll try not to take stress. No ways. You decide to become a trader and you think that you're not going to take stress. No, it doesn't work. The way it works is we should be capable enough to handle stress. We should be capable enough to identify and handle it better. The same situation will come for every one of us. So the good thing would be narrow down your focus, okay, and do not look for any alternative. So what happens is when you're getting stressed, when will you get stressed? When losses are more, when the markets are behaving completely wacky, out of your hands. Slow down, calm down, focus, bring your focus down to the bare necessities and handle it better. Don't get spiked up, don't get crazy and okay, I'm losing so much money and start shouting and jumping around. I've seen actually people breaking keyboards. Honestly, keyboards, they'll just take the keyboard and they bang it on the table and gone, it's broken. You go to any proprietary trading desk, I'm not joking, you'll find broken keyboards. Yes, earlier proprietary trading days nowadays is going a lot automated and algorithm driven, but even today I'm sure a lot of broken keyboards. So it's not about I will not take stress, I will not let stress bother me, or no, stress is not going to come, I'm all sorted. No, it's not going to happen. Forget trading. Isn't it obvious in our day-to-day activities? So it's nothing that we can, it's not something that we can hide from. We're not ostriches, right? So the way to approach this is make ourselves capable, upgrade ourselves from iPhone 1 to iPhone 12, upgrade ourselves so that we are capable to handle it better. So define some objective for yourself, grow some good mental physical habits. Good mental habit is very, very important. Fake it till you make it. This is something which a lot of people suggest, but yeah, you can, like telling yourself, I'm going to make 100 crores. You've not made it, but you make some well-defined objective for yourself, and you feel like yes, you've already done it. Never mind, but exercise focus, very important. Define rules, discipline. When I say rules and follow them, this follow them part is defining is no big deal. Writing down a to-do list is no big deal. Writing down what you want for yourself in the next 5 years and 25 years is no big deal. The damn big deal is doing it. Getting yourselves enrolled in a gym is not a big deal. Going to the Adidas showroom and getting a new bag, shoes, and gym gear is no big deal. And a nice body perfume and all that is not a big deal. Going there all dressed up in fluorescent green is not a big deal. But the big deal is doing the same grind for 6 months is a big deal. At that point of time, you don't care whether you're wearing an Adidas or something you picked up from Bandra Hill Road. Maintain a journal of your trades. I don't live in Mumbai, but you've noticed I take a lot of examples from Mumbai because my entire career belongs to that city. Whoever I am today, entire credit goes to that city. Though I don't live there anymore, I live in Kolkata right now.
It's 4 o'clock.
Maintain a journal for all your trades. This Excel sheet will help you. Do not fall for complex methods. Simple things is fine. Well-defined, simple approaches is just completely fine. And think in terms of risk. That's it. Think in terms of risk. There's so much we can talk about traders' mentality, about psychology. There are books written by John J. Murphy. You can read books written by Dr. Van Tharp on trading psychology. There's a book written by John J. Murphy, Trading Psychology. I think the name of the book is Trading Psychology. You can take a look at that. How can you control emotions while you're in a trade? To control emotions, Aditya, in a trade is to define your move. You will, if you are going to one place to the other and you have a map, and the entire road is new to you, you've never gone on that road ever before, but then you trust the map, then you will not get spiked. You'll not get psyched up. You'll not get emotionally scared. So the map is essentially nothing but a well-defined path. So if you want to control the emotions in your trade, it's better to have a well-defined path. That is a okay, what am I going to do? You don't want to think about okay, which turn am I going to take, left or right? You think about the path you're taking, right? So if it's well defined, I know from this point I'm going to take a right turn. So try and be as defined as possible. That essentially helps in reducing emotions. What to do when breakout happens and the trend return into consolidation, and spend some time there, and how to put stop loss in the gap down market. If the market gaps down beyond your stop loss, exit. Don't think about too much. Maybe a 5-minute window to think about is fine, but exit, because eventually it's not going to yield you any big return. It's a big psychological burden when a stop loss is overrun by a gap down. Having said that, do not look into gaps only as a negative aspect. There are many times when the market gaps up in your favor, when you're long and the market gaps up, when you're short and the market gaps down. These things also happen. Yes. Okay. What is your view on the use of algorithm going forward in the stock market? Algorithms will help you in execution. Algorithms will help you in stock identification and stock execution. But we need to understand that formula, that logic, the mathematics behind that algorithm is yours and mine. That brain that will create that algorithm, the belief of the system that will create the algorithm, is going to be your and mine. Is a 10% stop loss for option trading good, sir? 10% stop loss is good if you are basing your option trade based on the underlying chart, then use the underlying chart as a stop loss, or else yes, you can use a 5 to 10% stop loss, right? When news based gap down below stop loss is what we can do, just exit. Wait, give yourself a 5-minute window, check for the first 5 minutes, whatever happens, after that exit. You will feel much better. आप उसको पकड़ के रखेंगे, the whole day will be spoiled. The best thing would be to exit. How you think like a big player, how to think like a big player. The way to think like a big player is safety first, is not to lose a much of your capital. You go to a big player, you know what they will ask you? You give me 10-12% every month, you give me 12-15-20% every year, I'm fine. I don't need 100% from you. The big players do not want 100% from you. The big players think I'm fine with 15% every year, no problem, but don't give me minus 45%. So if you want to think like a big player, don't lose money, don't risk too much. Consistency is important. That's, I think, how the big player thinks. If it's a BTST call, will there be any chance of auction? Yes, if you've got yourself stuck in a trade in the cash market, you've sold, then yes, there will be penalty and there can be auction. They try to achieve more than inflation. Inflation, okay. Inflation is INFLA, not PH. Spelling of inflation part is INFLATION, inflation. When we write call option deep out of the money, what should be the stop loss? You should write call option deep out of the money better when you have the underlying. It's better that you have the underlying in your account, in your demat account, and then you should write. It's far better that way, the covered call. However, if you don't have the underlying and you're still writing deep out of the money call, then your stop loss should be the rupees terms, the amount you're willing to lose. You ask yourself that this is the strategy that I'm implementing. If it goes against me, how much maximum am I willing to lose? There is no fixed answer to it. For someone, it can be 5 lakhs. For someone, it can be 5,000. So give yourself a rupee stop loss. Okay, I'm going wrong. Okay, I'm down 5,000. I'm wrong. I'm down 15,000. I'm wrong. I'm down 20,000. Okay, no more than 20,000. Out. Okay, so give yourself a rupee stop loss. Abhishek has given me a dozen question marks. I don't know what that means. If I've missed your question, can you please? Okay, then he gives me a sorry. Okay, so with that, I end my theoretical sessions with you. An important thing to do would be to go through the recording of the strategy session, the strategy which I discussed yesterday, and the first half an hour of today. This will be very important when we meet Tuesday morning and Tuesday afternoon during live markets. We would look into these strategies and we would look how to find trading opportunities. If we have any doubt in the future, okay, you can always check with me over WhatsApp. You have my number, so you can do that in the future. Whenever you do that, do ping me by saying that you attended AST 41, and then you can ask your question. It will be much better for me to understand where we interacted, and it will be easier for me to answer your doubt. Okay, so we meet again Tuesday morning. I think it's 9 to 10:30, and then again in the afternoon 2 to 3:30. So 9 to 10:30. And make sure that your systems are on and you have the Spider software installed and open at your end. Make sure the Spider software is open at your end. All right. All right. Thank you, everyone. Thank you for joining in. Enjoy the rest of your Sunday evening. Take good care of yourself. God bless. Thank you.